Let's recap what was covered in Chapter 2, which is Week 3. We expanded on the accounting cycle. Chapter 1 covered the analysis of source documents, such as an invoice, or bill, or timesheet from an employee. You analyze the source document to understand what transaction is really taking place. Chapter 2 is when we journalize or book the transaction on a general journal. Now we use the concept of debit and credit instead of plus and minus, which was covered in Chapter 1. As a general rule, debits equal credits. This is known as a double entry accounting. On the general journal, we also identified the accounting date and any reference documents as well. After we record the transaction in the general journal, we record each debit or credit in the ledger. The ledger is categorized by account and identified by an account number, much like our banner ID is our identification number. All accounts of the business, such as cash, supplies, accounts receivable, accounts payable, capital, withdrawals, etc., make up the chart of accounts. Then we sum the total of each account in the ledger and record this as part of the trial balance. The debits should equal the credits on the trial balance. If it does not, then it is an error in our general journal or ledger accounts, which we need to investigate further. The trial balance is at a point of time, much like the balance sheet that we covered in Chapter 1. Only after the trial balance is prepared can we proceed to create the other financial statements, such as the income statement, statement of change in equity, and balance sheet. An alternative to the general journal and recording it into the ledger are the T accounts, which is a quick and dirty method of recording the balances for each account. Likewise, the left side are the debits. The right side are the credits. These amounts should be summed for each account. This total balance is brought into the trial balance.